Hold on to your seats, the market is going down. Imagine a morning, you've just woken up, sipping your coffee, turning on the news, and suddenly you see the market is crashing. The indices are in the red. The S&P 500 dropped by 3.2% in one day, while the NASDAQ plunged 4.1%, numbers straight out of a Bloomberg report. The charts look like roller coasters, and there's only one question in your mind.
What the hell is going on?
If you're a trader, you know this feeling all too well. Your savings are melting away. The Tesla shares you bought at $470 are now worth $225, a 52% drop in a single week. Your nerves are shot. Your phone is blowing up with drawdown alerts. And at the center of all this chaos is one man, Donald Trump. His tweets strike like lightning. One post about new tariffs on Chinese goods, and the market loses billions of dollars. His statements are like hurricanes, a threat to withdraw from NATO, and defense stocks fall 5% in an hour. His decisions shake the financial world like earthquakes. A 25% tariff on European imports, and automakers like Ford shed 10% in just 2 days. Millions of traders around the globe are tearing their hair out. But what is this really about? A brilliant plan to turn the economy in favor of the United States? Or just chaos that's destroying everyone who's trying to make money in the market? Today, we'll get to the bottom of it. More importantly, I'll show you how to survive this madness and maybe even turn a profit. So buckle up. It's going to be an interesting dive into a world of controlled chaos. Why is everyone panicking and afraid of losing money? Historical precedents. What do past market crashes tell us? Trump, a genius or a source of chaos? Who's losing? And who's truly getting rich? How did it happen that during a market panic you always get screwed? How to protect yourself and even profit from the crash. Why is everyone panicking? Imagine this. You're sitting at your computer, opening your investment portfolio, and all you see is a sea of red numbers. Stocks are dropping, crypto is tanking, and the headlines are screaming. Market in chaos, Trump imposes new tariffs, Bitcoin falls 3.5% after Trump signs order creating strategic crypto reserve. Your heart starts pounding, your palms get sweaty, and you've got just one thought racing through your head. What should I do? Sell everything right now or wait? If this sounds familiar, you're not alone. Millions of people worldwide are feeling the exact same way. Welcome to the world of market panic. The market is falling, and it's very real. Let's look at the facts. Stocks that seemed unbeatable just a short time ago are now in freefall. Nvidia has lost 16% since February 18th, sliding from $139 down to $116 in a matter of days. Tesla, down 37% since February 19th, from $360 to $224. Even Apple, that bastion of stability, hasn't held up, dropping from $248 to $211, a 15% decline. Now let's talk crypto. On January 20th, Bitcoin plummeted from a peak of $109,000 to $82,000, a 24% drop. Ethereum sank from $3,700 to $1,800, which is 50%, and Solana lost a full 58% since January 19th. If you had $5,000 in crypto, you might now be looking at $2,000 to $3,800. Feel your wallet getting lighter? Who's to blame? Trump and his tweets or posts on X? Why is all this happening? One major culprit is Donald Trump's actions. His announcements about new tariffs on Chinese goods or threats to break trade deals hit the market like a spark in dry grass. One tweet and millions of dollars evaporate. For example, when he started talking about a trade war again, investors panicked. What if China retaliates? What if companies like Apple lose their supply chains? And here's the outcome. The market is shaking like it's got a fever. Panic is contagious, but it's not just about the numbers. Look at what's happening on social media. Trump ruined everything. Bitcoin is dead. Time to sell and save whatever's left. People see these red charts and start shouting about the end of the world. The news seeing this can't help but think, maybe they're right. Maybe I'm next in line to lose everything. Panic is like a virus. It spreads from one person to another, causing impulsive decisions. Sell now, close positions, run from the market, stop. Let's take a breath. This affects you personally. You might say, I'm not a millionaire, this doesn't affect me. But think about it. If you have even a little money in stocks or crypto, you're already in the game. And when the market falls, it's not just numbers on a screen, it's your vacation fund, your car repair budget, or even that dream you've been saving for. Panic hits you in the nerves because it makes you feel like you're losing control. But here's what's crucial. Panic is natural. It comes for everyone. The main thing is not to let it take over. What is next? While you're watching those plummeting charts and hearing the online uproar, one question arises. Is this the end, or just a storm we need to ride out? Historical precedents, what do past market crashes tell us? So, the market is plummeting, and it feels like the sky is falling. But hold on, this isn't the first time politics or chaos have rocked Wall Street. Let's take a step back and look at history, what happened in the past, when political events shook the markets, and more importantly, how did the markets and stocks like Nvidia recover? Spoiler alert, they always bounce back. Let's dive in and find out why. The 2018 trade war, a glimpse of chaos. Let's rewind to 2018. Trump imposed tariffs on $200 billion worth of Chinese goods, and the markets reacted predictably. They fell. The NASDAQ, which includes Nvidia, dropped 17% in just 3 months. Nvidia's stock, it took a serious hit, plunging almost 50% from a peak of $292 to $133 by the end of the year. Sound familiar? Here's what's key. By 2020, Nvidia didn't just recover, it skyrocketed by 150%, reaching new highs. The takeaway? Political storms pass and strong companies adapt. The 2008 financial crisis, a worst-case scenario. You can't talk about market collapses without mentioning 2008. The global financial crisis, triggered by the housing market crash, led to a 57% drop in the S&P 500 from peak to trough. Nvidia's stock plummeted from $25 in 2007 to $7 in 2009, a staggering 72% decline. Yet by 2012, it had climbed back to $15, and by 2021, it reached $300. The lesson? Even in the darkest times, the market finds a bottom and eventually comes back. COVID-19 and lightning-fast recovery. Fast forward to 2020. The COVID-19 pandemic caused the fastest market drop in history. The S&P 500 lost 34% in 1 month. Nvidia's stock fell from $290 to $180, but by the end of 2020, it had rallied back to $300, and by 2021, it hit $300, $333. Why? Technology was the lifeline during lockdowns, and Nvidia, leading in AI and graphics, was at the forefront. What history tells us. Political turmoil, economic crashes, even a global pandemic can bring the market to its knees. But these events don't last forever. Stocks of major tech companies built on solid foundations don't just survive, they thrive once the storm passes. So the next time you see the market dip after a Trump tweet, remember, it could just be another chapter in the long saga of recoveries and potentially a great buying opportunity. Trump genius or source of chaos? Here's the twist. Trump is both. Sometimes he's a strategist, mapping out moves that bring in big wins. Other times he just tosses a grenade into the market to see what happens. But for you as a trader or investor, the question isn't who he is, it's how you can turn this instability into an advantage. Who loses and who strikes it rich? The market is like a roller coaster. Trump says something and everything shoots up or plummets. But while some people panic and lose money, others stay calm and rake in billions. Who are these losers and winners? Let's break down what happens when volatility hits the market and how it affects you, whether you're a trader or investor. Small players, $1 million panic. Let's start with those who usually lose, small traders and investors. Imagine you bought Tesla at $250 and then Trump tweets something about tariffs. The stock sinks to $200, down 20% in a single day. You're staring at a sea of red. Your heart is racing, and you sell everything just to avoid further losses. A few days later, Tesla bounces back to $230. You sold at the bottom and lost $50 per share, while someone else scooped up shares on the cheap and is now sitting on gains. Sound like a nightmare? It's reality for many. Why does this happen? Small players often act on emotion. They see a drop and rush to sell. They're unprepared for chaos and believe every sensational headline. Meanwhile, the big guys are rubbing their hands together. Big players, billions from chaos. Now let's talk about those who get richer. Hedge funds and major investors, they don't just survive the mess, they thrive on it. Take 2020, for example, when Tesla was the talk of the town. Hedge funds started shorting it, betting on a price drop. And guess what? When Tesla crashed from 900 to 600, they made $10 billion, according to the Wall Street Journal. You might have sold your shares at $200 and cried while they made off with billions, laughing all the way to the bank. These folks know how to play volatility. They've got the analytics, the capital, and most importantly, nerves of steel. While small investors panic, big players buy at the bottom or short at the top, turning chaos into profit. Why does this matter to you? Traders. If you trade actively, volatility is both friend and foe. The risk of a margin call is real. If the market tanks, your broker calls, and you could lose everything if you don't close positions in time. But if you're smart and use shorts or options, you can profit from a downturn, just like those who shorted Tesla. Investors. If you're a long-term investor, a drop could be your chance. While small players are dumping shares at the bottom, you can pick up Tesla at $200 and wait for it to climb back to $300. Some people cry, while others quietly grow wealthier. The bottom line. In this game, there are losers and there are winners. Small players panic and sell cheap. Big players use the chaos to scoop up billions. Traders walk the razor's edge between risk and reward, while long-term investors wait for their moment. The question is, which side will you be on? In the next chapter, we'll explore how not to be a loser and come out ahead. Why do we ruin everything ourselves? Why are we so often the culprits behind our own financial failures? Let's talk about the biggest enemy, our emotions, and how they drive us to make decisions that sabotage our chances of success. We sell in panic, lose money, and later regret it. Let's break down how this happens, who suffers, and what to do about it. Emotions, your worst enemy. Imagine a recent scenario. You bought Ethereum at $3,900, fully convinced it would keep climbing, but then the market gets volatile. Bad news. A major exchange gets hacked for $1.5 billion worth of ETH. Panic spreads on social media. The price tumbles to $1,800 and fear takes over. I'm losing money. I have to save what's left. So you sell. A year later, you find Ethereum at $5,000. Sound familiar? You've probably done this at least once, and you're not alone. This is a classic trap that millions of people fall into on financial markets. Emotions like fear, greed, or uncertainty drive impulsive decisions. In the end, we lose money where we could have profited if we had simply kept our cool. Who suffers and how? Traders. You're actively trading and you see a sharp drop. Instead of following your strategy, you panic sell at the very bottom, locking in losses. Or the opposite, the market's on a tear, you get greedy and buy at the top, then the price falls, and you're back in the red. Investors. You're in for the long haul, but every time the market dips, your confidence wavers. What if this is the crash? What if I lose everything? You think and sell during the downturn. Then the market recovers, and you realize you missed out. A real example. In 2020, Bitcoin fell to $3,800. Many sold, thinking it was the end. A year later, it was at $60,000. Those who gave in to panic lost their shot at a major windfall. Why do we act this way? Our brains fear losses more than they enjoy gains. It's called loss aversion. Losing $1,000 hurts more than gaining $1,000 feels good. When the market drops, we'll do anything to stop the bleeding, even if that means selling at the worst possible moment. Media and social networks only amplify the panic with screaming headlines. Everything's collapsing. Sell now. And we blindly follow the herd on autopilot. How to avoid sabotaging yourself. Here are a few simple steps. Make a plan. Decide in advance when you'll buy or sell. For example, I'll sell if the price drops 20% in 1 week. Then stick to that plan, even when your emotions tell you otherwise. Set stop losses. Automate your trades so decisions happen without panic setting in. Take a deep breath. Before making any move, pause. Remember that markets do recover over time. Study history. Look at how markets rebounded from past crises. For example, in 2008, the S&P 500 fell 57%, but within 5 years it had surged 200%. Knowing this can help you stay calm. The bottom line. Emotions are your biggest foe in the financial markets. Traders suffer from impulsive moves, investors from losing faith in the long game. The Bitcoin example shows how easily we can deprive ourselves of profits by giving in to panic. Now you know why it happens and how to fight back. How to protect yourself and even profit during a market downturn. The market is stormy, the news is scary, but you have a chance not only to protect your capital, but also to earn money during a crisis. Below are practical tools and strategies, from safeguarding your funds to profiting from falling prices. You can start using each step today. 1. Diversification. Spread out your risk. What is it? Diversification means splitting your funds across different assets so you don't lose everything at once. Think of it like having a varied meal: pizza, salad, and soup. If one dish is spoiled, you won't go hungry. How to do it? 50% in stocks across different sectors: tech, energy, retail. 30% in bonds. They can provide stable growth when stocks fall. 20% in cryptocurrency: Bitcoin, Ethereum. Risky, but promising. Why does it work? In 2020, a diversified portfolio weathered the crash. Stocks fell, bonds rose, and crypto eventually soared. Who is it for? Investors looking for stability. Traders who can't risk losing everything at once. Second, stop losses. Your lifeline. What is it? A stop loss is an automatic order to sell an asset if it drops to a certain price. It helps you avoid acting on emotion and prevents massive losses. How to do it? Set your stop loss about 5 to 10% below your purchase price. For example, if you bought Nvidia at $250, place a stop loss at $225. Why does it work? In 2018, traders who used stop losses lost far less than those who held on until the very bottom. Who is it for? Traders. Investors who want to limit losses. 3. Hedging. Insure your capital. What is it? Hedging involves buying insurance, such as put options, which give you the right to sell an asset at a fixed price, even in a market crash. How to do it? Say you own Tesla shares at $200, you buy a put option for $10 with the right to sell at $200. If the price drops to $150, you lose only the $10 premium instead of $50. Why does it work? In 2008, hedging reduced losses by about 30%. Who is it for? Investors with large portfolios, traders prepared for volatility. 4. Short selling, profit from a decline. What is it? Short selling is when you borrow an asset and sell it, planning to buy it back later at a lower price. Example, short Tesla at $250, buy it back at $200. The $50 difference is your profit. Real case. In 2022, after Trump tweeted, some traders shorted Tesla and made $50 million in a single day. How to start? Open a margin account with a broker and learn the rules of short selling. Who is it for? Experienced traders, risk takers. 5. Buying the dip. Seize the moment. What is it? Buying assets at their lows during panic selling, expecting them to rise later on. Example, If Nvidia falls to $100 and then climbs to $300, buying at the bottom yields significant profit. Real case. In 2020, Bitcoin dropped to $3,800 but was at $60,000 a year later. How to proceed? Keep an eye on the news and charts. Use fundamental and technical analysis to identify a potential bottom. Who is it for? Investors who believe in long-term recovery. 6. Options and volatility ETFs. Betting on chaos. What is it? When the market plunges, put options and volatility ETFs, e.g. VXX, often rise. It's a play on market turbulence. Example: a put option on Tesla at $250 will profit if the stock falls to $200. In 2020, as the S&P 500 dropped 34%, VXX soared 80%. Who is it for? Experienced traders, investors ready to work with more complex instruments. Conclusion: diversification, stop losses, and hedging will protect your capital. Short selling, buying the dip, and options can open the door to profits. A crisis isn't the end, it's an opportunity. Short Tesla, buy Nvidia at rock-bottom prices, and capitalize on volatility. The key is managing risk wisely and acting smart. We've reached the finale, and now it's time to answer the question, what's next? The market's shaking, the headlines won't stop, and Trump continues his games, but you're already prepared for anything. Let's recap and give you a clear action plan so you can not only survive this chaos, but come out on top. Forecast: the market always recovers. The first thing to remember is that the market will recover. History has proven it time and time again. Think back to 2020 when the S&P 500 plunged 34% in a single month due to the pandemic, but then rallied 50% within a year. Or Bitcoin after the halving that same year, skyrocketing 300% from $9,000 to $60,000. And after the 2008 crisis, the S&P 500 rose 200% over 5 years. Crises come and go, but the market always finds its way back up. For investors, even if everything's crashing now, hang in there. Recovery will come. Be ready for the upswing and use market dips to buy more. For traders, watch for the trend reversal. When the market finds its bottom, a bounce is coming and you can capitalize on that. Your game plan for any scenario? Trump can keep rocking the market, but you can stay calm because you have a strategy. We've already given you all the tools. Here's how to use them. Diversify, spread your money across stocks, bonds, crypto, and gold. This way, you reduce risk and won't lose everything at once. Hedge, set stop losses, or use options to protect your capital from sudden drops. Buy in a panic. When everyone else is selling out of fear, that's your cue to jump in. These steps are universal. For investors, you preserve your capital and wait for growth. For traders, you play the volatility game, profiting from shorts or rebounds. You're ready to win. We've taken the full journey together, from chaos and uncertainty to a clear plan of action. Now you know the market will bounce back, and you have strategies for every scenario. Trump can shake up the market all he wants, but you'll keep your cool because you have everything you need, not just to survive, but to thrive.